The yen continues its rally and reaches a 6-week high against the dollar. Welcome to Market Insight. I'm Ludovica Brignola. The yen has rallied for a fourth day on Thursday, reaching a 6-week high. That's as traders ditched their bets against the currency, but also as a plunge in global stocks drove investors towards traditionally safe assets. So what's happening to the yen? Well, to help answer that and more, I'm joined by Jeremy Stretch, Chief International Strategist at CIBC. Thank you very much for being with us today. So,
Pleasure.
The yen, what's happening? Why this sudden revaluation?
Well, there are obviously several factors in play. One, of course, is the generalized unwind of risk appetite in the course of the last few sessions, really emphasized by the retreat in some of those key Magnificent Seven stocks in the US. So we've seen a degree of risk negativity. I think also we've seen a recognition and a realization that yen short positioning was extremely excessive. So we had a rapid buildup of yen short positions, but also at the same time as we're considering policy easing from most global central banks, markets have been starting to up expectations or reprice the backdrop for next week's BOJ meeting. So at one stage earlier in today's session, we had almost 9 basis points of tightening price for next week. So combination of those factors have really encouraged a significant risk reversal, and accordingly, those risk barometer trades, including the majority of those of which are short of yen, have been unwound quite aggressively.
Interesting, excessive positions on the yen, as you were saying. So what does this sharp revaluation of the yen mean for carry trade, as you were saying? I mean, and what currencies would be affected the most by these carry trades unwinds?
Well, if you're looking at a risk barometer and or a carry trade, then clearly a cross like Aussie yen is one of the most influential in that particular regard. So when we look at what we've seen in terms of the performance of the Australian dollar against the Japanese yen over the course of the last 2 weeks, we've seen more than a 9% move in that particular cross. So that's really reflecting that sort of risk barometer and or carry trade at its most visceral, if you like. So what we are seeing is that those currencies which are very much driven by global growth or commodity dynamics are certainly being pressured to an extent, particularly those that also have elevated carry, such as the Aussie, at the expense of a return to those safer haven markets. And that includes the yen, that includes the Swiss franc, but also, ironically, somewhat to an extent, also a little bit of euro interest coming back in that context as well.
Right, and let's move to the UK now. In light of what we've seen in terms of the new government policies, what effect do you think all this will have on sterling in the medium and long term?
Well, I think that's an important point. What really characterizes the medium and long term, because we have seen a substantial re-rating of sterling valuations over the course of the last few weeks. And we've seen that reflected in terms of a rapid build-up of speculative long positions. So in the same way that we've seen a massive build-up of yen shorts, we've also seen a concurrent build-up in sterling long positions of investors have backed the presumption of a return of stable government and a more proactive business-orientated backdrop. So we are seeing, I think, the prospect of a stronger and re-rating of sterling's valuations over the course of the next 2 to 3 years, perhaps. But I think in the shorter term, it's still the case that I think some of that positioning does look a little excessive, particularly if we're still very mindful that the Bank of England could well be in play in the context of a rate cut as early as next week's meeting. Now, we have been anticipating a rate cut for some time. The market is just upping those expectations just a little. And I think that will play into the narrative of sterling cheapening up, at least in the short term. So I think we have to differentiate between those short terms and those much longer term dynamics where I think FDI flows will be much more encouraging. But I think it's too early to trade that just yet.
Right. Meanwhile, across the pond, the market is pricing in a Fed cutting cycle starting in September. What does this mean for the dollar? Also, considering that other major central banks, except, of course, the BOJ, are about to be in cutting mode.
Well, I think what we're seeing is that the US economic exceptionalism that really drove the dollar higher in the early part of the year is diminishing. So in a sense, if we are going to see slower growth and or Fed easing, that should imply that there is a graduated cheapening up in the dollar, particularly if investors start to become a little more mindful of those twin track deficits that are still very large in the US, both in terms of the current account and the fiscal shortfall. So that's the sort of the downside risk for the dollar. But of course, there is still that overarching issue of political risk and uncertainty in that regard, in the context that perhaps we could well see a steeper US curve. So there are sort of two-way pulls in terms of the dollar, but I think it may well be the case that unless we see a significant uptick in terms of a political inspired negativity, it may be the case that the dollar just cheapens up slightly. And it may well be the case that economic exceptionalism, as I say, that has been dollar supportive, will start to dissipate into next year.
Really, really interesting. And one last point on Europe. We've seen very disappointing PMIs in Europe yesterday. Today, a business survey showed that essentially companies in the bloc's two largest economies, that's France and Germany, are growing more pessimistic. What's happening in Europe, Jeremy?
Well, of course, the Eurozone is very much driven by external demand, in particular on the manufacturing side when you're looking at the key economy across the Eurozone in terms of Germany. So if we are seeing further question marks about the Chinese growth narrative, now we've seen, of course, unexpected rate cuts through the course of this week. So the Chinese are doing their level best to maintain activity and maintain sentiment. But question marks about global growth are and will prove to be problematic for the Eurozone. So we've seen those forward-looking survey indicators retreating quite significantly. Expectations within the IFO survey dip below the current reading, and that's a rather negative backdrop. So I think that does suggest that the euro macroeconomic projections are going to be challenged. But I guess from a euro perspective, it's still the case that obviously those cross currents in the dollar are probably limiting euro dollar downside, at least for now. But it does seem difficult to be really finding solid and significant justification to buy euro at these levels.
Great analysis, Jeremy Stretch from CIBC. Thank you very much for being with us today. And
thank you.
That's your market insight. Don't forget you can watch more videos on Reuters.com.